Learn the art of investing on Moneywise.
Good to have you join us on the Moneywise Podcast. My name is Seetal, and I get to catch up with people who've been there and done that quite literally in the world of all things money, investments, and then some. And the person who's going to be joining us on air today is Kashyap Mody. He is head of Treasury, Jio Platforms. And as you can fathom, he has rich experience in managing cash investments in fixed income and also equity assets with a team of research analysts and portfolio managers. So we thought, why not reach out to Kashyap to give us some pointers on asset allocation for one, what that really means, and generally speaking, investment ethos in these very volatile times. Now, a little bit more about Kashyap. He worked with Citibank India across different treasury roles in a prior avatar. And guess what? He's also a marathoner. So plenty to take away from someone like Kashyap. But let's get started by welcoming him at the very least. Thank you so much, Kashyap, for making us some time on the Moneywise podcast. How are you today?
I'm good. Thank you. Hello, everyone. And thanks for having me here.
Our pleasure entirely. And I thought I should ask you a little bit about your own investment journey as a young man. I suppose you came across one moment in life when you said, oh, okay, this is what I really need to do with my finances. Is there a moment like that, a turning point or a pivotal moment when you came upon that realization, Kashyap?
So I think early on in my life, I had got one funda right for me, which is you got to start saving. And once you start saving, you got to start investing. So that happened pretty early in life. But at some stage, 8-10 years later in the career, I realized or understood why different asset classes are important and why you got to think about inflation beating returns, post-tax, etc., etc. In today's world, all this knowledge, awareness is very easily available. But probably 15-20 years ago, it was not that easily available. You had to read. Now you just have to click a few buttons.
And I'm glad you made that distinction between saving and investment and brought in asset allocation as well, because that is a topic over here. So I got to ask you, right, with such an extensive career in finance, how would you define asset allocation? Is there a different way in which you view this instrument or approach to your investments?
The way I think about it is, right, as a subject, it is very individual specific, okay? And it's a function of how much you know, how much you are aware, and what kind of risk appetite you have. So while I understand someone in the same domain would probably know and understand things far better than someone, say, for example, who is a doctor or lawyer or a mechanical engineer, it's possible, right? However, these days, everybody knows everything about finance, but the appetite to risks are very different. And hence, the approach is very different. And that is why you got to understand what you are and what you want to achieve. Right? Because my goals will be very different from your goals. So while there is a broad thesis that yes, asset allocation is necessary and important, at the same time, you got to eventually customize it to your own self. A lot of that has to be done by you yourself.
The follow-through question to that, Kashyap, is why do you think this is crucial from both a corporate treasury perspective and also a personal finance perspective, asset allocation? How would you drive that point home?
So clearly, right, while we all believe and understand and read a lot about where markets are headed, where potentially you can make money and returns and what kind of asset classes can give you different returns. There are always unknowns. Being 20 years in financial markets, I've realized nobody knows the future. People only guesstimate the future from what they know, what they read, what they research. But in reality, nobody knows, right? In the last 20 years or 15 years, we have had many large events which have really shaken financial markets, right? Whether it was the global financial crisis, or it was the inflation scare in 2016 for emerging markets, or for that matter, COVID, and then after COVID, again, an inflation scare. So the markets then behave very differently when unknowns occur. And hence, over a long period of time, the discipline of asset allocation is necessary because it kind of insulates your volatility. It tends to diversify and reduce your risk. And which is what is important at a personal level as well as an institutional level, right? See, we all want returns, but the ability to stomach risk and volatility is very different. So diversification kind of helps us manage that aspect well. At the end of the day, we all want to sleep well, right?
Yeah, absolutely. And I'm sure there are broad strategies out there. We are always told by financial advisors that we need to sit down and discuss your personal map. But yet the common man, thanks to WhatsApp University and a lot of things, thinks that risk appetite is usually higher in younger people and diminishes with time, right? So I wanted to bust a few myths and talk about what these strategies are, the various types of asset allocation strategies that are out there, along with some misconceptions that people might have. If you could do that for us, that would be great.
Yeah. So, see, broadly, the way I think about it, there are four kind of assets: equities as an asset class, fixed income as an asset class, then there is real estate, and then there is commodities, which is largely gold and silver for at a personal level. You distribute your wealth or a portfolio across these four asset classes. Every asset class has different quirks, different pros and different cons, right? For example, I really love to stay away from real estate because for me it is not something which is liquid. I would like my money to be available to me in 2 days, 3 days, 7 days.
Right.
But real estate doesn't allow me to do that. But for somebody else, it might work very well. So you got to distribute your exposure across these four asset classes. And then depending on what your goals and horizons are, somebody who is earning well in career, has a stable job, or is earning a good salary, has a 20-year, 30-year horizon, he can take far more exposure to equities than someone who is, say, 55 or a single parent and wants to now save only for the next 7, 8, 10 years. Right? So the goals are very different, right? And hence the exposure for that person to a riskier asset class has to be much lower. And then that's why you take safety under fixed income. Right? So the mix is very important and necessary. And it completely depends on person to person. But it is important that you know what you're getting into. If I have higher exposure to equities, it is more volatile. To reduce that volatility and increase the certainty of returns, I got to have more fixed income. But the returns will then be lower. I got to bring in gold as some part of my portfolio. Because gold kind of tends to behave differently at different points in time, which kind of has an ability to stabilize your overall portfolio return and risk.
So, I mean, clearly there are different approaches based on the asset class, and you need to weigh the pros and cons of each one before you determine what's the correct distribution or mix really for you. And you spoke about equities, right? I want to dwell there for a bit because we've seen what has happened in the market. So much of chatter around the current trends and also some of the movements in mid caps and small caps specifically, right? So while on the topic of equities, what's the ideal approach for investors to tap into some of these opportunities? Is there like a strategy over there that you have always sort of relied on to give you the best sort of returns?
So first and foremost, right, for most of us, I think we got to use the services of a professional money manager, which can be either you use the mutual fund umbrella or you use a PMS or you use an AIF. Okay, but do use that. It comes at a cost, like mutual funds cost less than 1% or almost 1%, right? Nothing more. But it is all worth it, right? When I am unwell, I don't diagnose myself and prescribe myself a medicine.
That's right.
I go to a doctor and do it. Precisely the same reason when managing your own money and building a wealth or a corpus for the long term requires professional advice, and hence taking services of a mutual fund platform or AIF platform are important and necessary. And stay away from tips and advices given by friends over cocktail parties. I think you got to it's a lot of fun, but it doesn't really, it's not advisable for long-term wealth creation.
Right.
And within that, then of course, there is a spectrum of risk also, right? There are large caps which are low risk and hence more stable on terms of returns. And there are mid caps and small caps where the risk spectrum continues to increase. Right? So, see, the most ideal thing is have a mix again. But even there, for example, when I'm advising young people, right, who are doing well in their careers, I try to tell them that, you should have a larger allocation to mid and small caps because over longer periods of time, they have an ability to outperform large caps. And hence you got to have that blend. But if someone is 55 and asking me that question, I'll probably tell him or her that you got to have at least 50% of large cap exposure.
Right.
But today, thankfully, there are balanced funds which have a mix of equities and debt. There are flexi cap funds which have a mix of large cap and mid cap and also small cap. And now there are even multi-asset funds, right, which have gold and fixed income and equities. So now the mutual fund platforms actually offer a whole mix. So you got to be aware what you want. And if you can't understand it as well, as I said, you got to solicit help from someone you trust. right? Because it's a matter of money. You want to have someone whom you can talk to and trust. In India, probably we don't talk as much about personal money, finance, and portfolio building, right? Because that probably at times is an embarrassing subject. I don't know why, but probably at times is it.
Yeah, I think it's a social thing. Also, we think, talking about money is an inelegant thing. Why not talk about the weather, etc.? But I suppose there are times, you spoke about this temptation, of reacting to things that are whispered in your ear at cocktail parties and then act on them. And I'm quite certain you have in the length of your career seen a lot of people respond in a very knee-jerk kind of a way to immediate short-term market dynamics, right? What is your advice to people who have a tendency to go back every time, even though they have an advisor at their thing? I've heard this. Can we just change my allocation a little bit to reflect the current dynamic? Have you seen that happen? And what would you say to folks like that?
Yes, I mean, we see that all the time, right? Because I mean, it's human. It's honestly, it is human to react to such things. It's human to react to temptation and greed. But what one got to understand is my journey to building my wealth and my portfolio is very different to my neighbor's journey or my friend's journey. And hence, I need to stick to my journey. I need to walk my path. Having said that, if you have that temptation, if you want that adrenaline rush, if you want to have such conversations at such parties, then what I tell people is keep aside 10%. Keep aside 10% and do all the jugglery in that 10%. And if you think you're doing well, fine, continue to do it. If you realize, okay, it's not worth it, you please come back to that 90%.
Right.
So that way you tend to satiate your adrenaline and your dopamine, and at the same time you're not impacting your wealth creation journey, which is actually a long journey, and bulk of it starts kicking in once you're 40, 45 and you go through 2-3 cycles, right? So at 25 you will not see that, at 30 you might not see that, but at 45 you will start seeing the value and the impact of being disciplined investor over the last 10-15 years.
Very interesting. I for the first time I've heard like a concrete way of addressing that little craving that all of us tend to have every now and then when you see the neighbors making pots of money and then what's happening to me. So I'm glad that came out over there. But sometimes you might realize that rebalancing your portfolio is required, is the need of the hour, and you can't just like fill it, shut it, forget it, and hope that everything's going to be well for the next 5 years. What do you recommend investors do to rebalance your portfolios? What is the approach, and how often should they do something like this? And what are the factors that should inform such a decision?
Yeah. So there one got to do a health check of the portfolio at least every 9 months or 12 months, right? See what you're doing and where you are. So it's like you do your body checkup, right? And you do it once a year, you do it twice a year, you do a full checkup of your portfolio and your allocation, what you're doing. But it need not be, it's not necessary that you got to rebalance every time you do a check.
Right.
You might just be doing the right thing. So you don't need to react every time. You got to react, say, probably every 2 years, every 3 years, where either your goals and needs have changed or your ability to invest more and save and invest has increased because for various reasons, or some portion of your portfolio is really doing bad and hence you need to react.
Yes.
Right. So you got to have these things in your mind. However, I am a big believer of that action bias is more harmful.
Okay.
Our urge and need to act every time with the belief that whenever I act, I'm adding value. It's not correct. It's a wrong belief. It's a wrong belief.
Right.
Right. And we got to understand that every time I reallocate, and that means I sell or I redeem, and I end up paying 10% or 10% tax on that.
Right.
That 10% goes away from my investment. Correct. I'm only investing the balance 90 rupees.
Okay.
Right. So my money invested also drops.
Exactly.
So while you got to reallocate and react on your portfolio, but it has to be at a lesser frequency and not at a larger frequency.
So basically not entirely fill it, shut it, forget it. That model is probably not advisable.
You can't do it for 20, 30 years, right? You can't do that.
Yeah. What would you recommend to youngsters today? We spoke very early on about starting early, and then you mentioned the kind of advice that you would like to give younger people with respect to asset allocation and look at, small and mid cap, etc. But 3 valuable pieces of advice that you were given at some point in your life and you never failed to pass on to other people with respect to managing money.
So now, at least what I end up doing is tell people that first and foremost, save and invest. Start there. Even if you're a teenager, right? It doesn't matter. Save part of your pocket money and invest that, right? So it is very important to get into that habit. Okay, finally, these are habits. And if you stick to those habits for long term, you will see extreme gratification, which is at the back end. But it is the habit which is important. You got to have that discipline. And as parents, we got to teach that to our kids, or you got to teach the youngsters who join your company that this is important, this is necessary. And then beyond that, you then try to tell them, okay, there is asset allocation, there are financial assets. Do not rush after dopamine. Try to get into this habit of building wealth for the long term. Use various regulated platforms to invest. Otherwise, you can really have nasty experiences at times. But clearly, for me, the most important thing is the habit and starting early. Then things fall in place. See, these days, as I told, right, there's a lot of knowledge and information available.
Right.
So you got to consume that, at the same time have the right temperament to not react to everything and every time.
Right.
So long-term building wealth is very doable. It is a simple formula, but it's a long journey. And hence people find it difficult. It is very temperamental. You don't require a high IQ to have a portfolio or a wealth build for a long period of time. You need the right temperament.
Yeah.
And you need simplicity in your portfolio. The other thing, of course, that we got to look at all investment returns post-tax.
Okay.
Right? Because at times we tend to forget that. For example, a 7% fixed deposit with 30% tax is very different from a 10% asset with only 15% tax, right? So you got to think about it like that. And at the end of the day, the returns on your investments post-tax have to beat inflation. In India, we experience inflation of broadly 7 to 8%. 6 to 8%, yeah. So take an anchor point of 7. Your investment returns over long periods of time on a post-tax basis should beat that 7% or 8%.
Right.
Otherwise, you're not really getting richer through your wealth. So inflation beating post-tax returns is the driving factor to choose your assets.
Yeah, and I suppose, Kashyap, correct me if I'm wrong, if you were saving up for education, for example, then that the inflation there is a little bit higher than it might be.
Much higher, of course. It's much higher, right? For a lot of us, the largest expenditure after your own house is your child's education. And these days, the expenditure is only going up.
Yeah.
Right. So you got to have a portfolio for that. Thankfully, as I said, right, there are ample combinations of investment classes available, tools available to go there. Right. But it's just the discipline.
Yeah. I think you've driven home the point of discipline, of starting early and mapping, one's choices to one's life's aspirations pretty clearly over here, and not listening to the chatter, which I think was very important. Entire topics and books are written on behavioral finance and psychology, etc.
Just on that one point.
Yeah.
There are far lesser books written and read on behavioral finance than on how to understand companies and buy stocks.
Okay.
But for personal wealth creation, it is behavioral finance which is far more important.
There you go. So any recommendations, any books that you have read, Kashyap? I might as well ask you right now, some things that have been, sort of significant on your bookshelf in recent times?
I think a couple of years ago, I read a book by Gautam Baid called The Power of Compounding. It was a mix of building wealth through equities or a portfolio creation and building good health through fitness regime. So I like that book a lot. I, of course, like The Psychology of Money. Clearly, it is important that most of us read that book. And the early we read, the better we might just get at managing money. Right? So I think for the topic that we are discussing, I think these two books will be up there.
So we've got book recommendations, and you mentioned the word health, financial health, right? Sometime back. But I want to do literal health over here, because I'm sure there are commonalities between how you approach your finances and how you approach your own health. You're a marathoner, and I'm sure that takes discipline. Tell us a little bit about the things that are common to the art of running and the art of making money.
Any kind of fitness regime, right, has to be there for the long term and has to be done in a disciplined manner day in, day out, right? So if you're, for example, training 3 days a week, 4 days a week, that's fine. But be at it every week, every month, every year. That is when you will start seeing great benefits 5, 7, 10 years down the line. Doing something for 3 months or 3 weeks and then taking a 3 months break, then starting again, stopping again really does not help, right? So clearly, it is exactly the same approach. Be disciplined and show up. and then things over a period of time fall in place. It's not necessary that you got to do high intense workouts, or you always run full marathons. No,
Right.
even if you are consistent and just running 10-kilometer races, it is great as long as you're consistent, right? So consistency is the key. Of course, it requires the same discipline in both places, right? Whether it is managing,
Money.
building your portfolio, managing money, or health for that matter. Consistency, discipline, and at least for me, what long distance running has given me is a great temperament.
Huh.
It helps me think clearly.
Okay.
It helps me probably simplify issues, okay, and keep out the noise, because it helps me identify what is noise.
Right.
Then when you try to bring all that in the domain of managing money or building your own portfolio, these things are supremely helpful, right? So hence the ability to not rush to temptations is far higher, or the clarity of what I'm getting into is very clear. So it's not that I don't do things which are risky, for example, in terms of investing, but I
Right.
know what I'm doing. I know how
Correct.
much I will do it for, right? So that clarity is very necessary.
Is there any last word of advice that you would give to, and I want to ask this on account of the fact that we are always talking about different groups of people. There's women, there's the elderly. So specifically for these two groups, right? I thought maybe if there's some words of advice on their financial journeys, what would you say to them, Kashyap?
So for both, right, for women or elderly, cause it is important and necessary to be completely aware of where finances are, where money is, right? For a homemaker, if she's not the decision maker, doesn't matter,
Right.
right? But you got to know where your family has invested the money, because you need to have access to it if something goes wrong. Okay, hence the point of nominees, having wills, access to bank accounts, access to demat accounts has to be there. If something goes wrong in the family, you can't be, the husband's demat account might have $1 million, but if the family can't access for 2 years, that's sad and bad.
Yeah.
Right. Same way as we grow old, we got to simplify and consolidate our wealth and investments so that our legal heirs or our kids are able to access it easily, right? If, for example, I have a property in Chandigarh, I have a property in Coorg, and then I have a property in Jaipur, and my son is studying in US or working in US. You have to believe that he's not going to come and claim all of those.
You're right.
Right?
You're
So
right.
you got to really simplify it. Okay, I did all of that in my journey from 25 to 55, 60. But abhi ho gaya. I got to consolidate, put it all together so that my kid, my son, daughter, or anyone whom am I giving it to, right, should be able to access it easily. So that they don't spend 5 years getting access to it. I think that is something that a lot of us probably don't do, but we got to do. They don't realize that you will struggle after they're not there. You will struggle to get access to that, even if it is 10 lakhs. You will not like to let it go, right? So you will spend 2 lakhs and 3 years getting access to it.
You're right. I can see the numbers are like being calculated quite rapidly, but then,
I don't know. Being numbers guy, numbers really come easily, right? But
I wanted to ask you about numbers, but then we get scared. Normally in these podcasts, then people consume those numbers for what they literally ask.
I think these are all concepts that we got to drive home, right? Even if you make 10% a year for 20 years, that's a lot of money.
A lot of money.
You don't don't need to chase 18% every year.
Right.
Yeah, but it's just that in our quest for chasing 18%, you don't land at probably at times even at 10%.
10%. But you're right.
But it is the concept of long-term investing, discipline, staying there is important, I think, right? And I think India is really getting it right, finally, after a long time.
Yeah.
Right? So I strongly believe Indians will be very rich 15 years down the line.
That is nice.
If for people who are not in business, right? People who are in business, a lot of them might end up doing very well. But for people who are not in business, way to wealth is equities. That is probably the only way. It comes with volatility, it comes with risk, but I think for us there is no other way.
But these are extremely valuable, Kashyap. It's been brilliant chatting up with you. So many different pearls of wisdom that we need to string together now, and I hope our listeners are able to wear the mala of success coming from Kashyap Mody. Thank you so much for joining us on this podcast, Kashyap.
Thank you. Thanks a lot, Seetal, and thank you for having me here.
You're listening to Moneywise, brought to you by Bandhan Mutual Fund. Check out the rest of our series for more insights on investment and personal finance. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.